An 86% return over the last decade, outperforming many other markets, and notable resilience in the many sell-offs that markets have seen over the years. Clearly, India's domestic bond market has already had a lot to offer. However, the central bank has been hiking policy rates. Adverse weather has been driving high food prices, and the US dollar has generally been strong. So would you have to be a little bit crazy to invest in this market now? Absolutely not. In this video, we discuss why we believe this continues to be an opportune time to build what could be a very important allocation to the Indian bond market. Now, inflation peaked in 2022 and has generally been coming down. After 250 basis points of policy rate hikes, the Reserve Bank of India arguably doesn't need to raise policy rates further and hasn't done so since February. Even more recent food inflation is already softening as rainfall improves and the harvest season concludes. This has left bond yields at very attractive levels, above 7%, higher than the policy rate and inflation. More importantly, we expect yields to fall over the next 15 months as inflation declines and the policy rate is cut by between 50 and 100 basis points. Falling yields equals good performance from rupee bonds. Currency risk should always be a consideration for investors. However, the rupee's volatility is at an 18-year low of only 3.4% and is typically 2 to 3 times lower than the volatility of other emerging market and global currencies. A smaller current account deficit, strong foreign direct investment flows, attracted to the positive India story, and the central bank's high level of foreign exchange reserves, which it uses to manage volatility, all support the currency. This also helps to keep the volatility relatively low, at only around 6%. For an investment-grade market, that's pretty good. And we argue, following a decade of reforms, India is long overdue for a credit rating upgrade. As we discuss in another video, sensitivity to other markets is low, making it a great diversifier as foreign investors generally don't own this trade yet. And this is important. The environment remains uncertain and a number of asset classes are not performing all that well. As a result, it could be prudent to have an allocation to a diversifying, lower volatility strategy like the Indian bond market that has consistently showed it's resilient through challenging environments. Finally, after years of capital market reforms, big changes are coming. As we anticipated, it has been announced that the Indian bond market will be included in JP Morgan's Emerging Market Local Currency Bond Index, and other index inclusions will likely follow. This is huge. The market is going global. As we saw with China's bond market, this would increase the focus on it and likely attract significant portfolio inflows. In summary, given its attractive valuations, favorable risk characteristics, a supportive policy rate outlook, and global index inclusion, the timing remains good to begin to build a position in the domestic Indian rupee bond market. Many thanks for watching and see you next time.